with the title of today's presentation, Tax Advantaged Oz Investing, the Future of Oz and the 10% Preferred Return Market Square Oz Investment Opportunity that we're currently sponsoring. We are what's called a 506C. It's a Reg D offering, and this presentation is not an offer to sell, but as a 506C, we are allowed to do what's called general solicitations. However, investors that go into these types of programs must be accredited. So if you do have interest in our program or any of our offerings whatsoever, please contact us and we'll be sure to get you the private placement memorandum and all the particular legal documents and allow you to talk to some of our experts before you make any decisions. So thank you for hearing me out on that slide. So our whole goal today is really to present information to educate you, to help you make the best informed decisions. So let's jump right in. I also wanted to show you something we're doing that's new. This is a QR code for our website, and you'll see in the bottom right-hand corner of every slide today a QR code like this. If you'd like to go to our website, or you can't stay for the full presentation but want information, and you don't have to actually go to the web to look us up, just take your camera on your from your phone, take a picture of this, or just put it on this picture, and it'll go right to our website. You can fill out the submission form, and we'll get right back to you. So at any time, just go ahead and go to the right-hand corner of the presentation, and you'll be able to go right to our website. So let's just jump right in. A digest of what we're going to be covering today. I'm going to do a quick introduction and welcome our speakers. I'd like to give everybody an introduction to USG Realty Capital and what it is we do and how long we've been around, etc. Then we're going to jump into some Opportunity Zone basics with Jake Devine from Oz Fund Hub. He's also going to talk about the state of the industry right now. And then we're going to have a discussion about, is it the right time to invest in Oz funds? And we'll take a look at the current trends and economic statistics and sort of look out into the future a little bit about the viability of Opportunity Zone investing. It doesn't make sense right now. And then we'll start moving into our particular USG approach to Opportunity Zone investing. We are unique to the rest of the industry and the way we go about our approach. We take what's called a wealth advisory approach, and I'll talk about that. And then we'll be able to dive into our latest opportunity and offering called Market Square Apartments. It's a 10% preferred return offering. And we have our developer partner, Andrew Spellman with Plus Capital, here to talk about that project. And then we'll open it up for Q&A. We expect the entire presentation to last no more than an hour. And we'll open it up for Q&A for as long as we need to. So let's jump right in. I'll just do a quick introduction of myself. My name is Greg Genovese. As you probably heard earlier, I'm the founder and CEO of USG Realty Capital. I'm happy to say I'm in my 34th year now of the real estate securities industry. I go back all the way to 1989, from traded REITs to non-traded REITs to 1031 exchange programs, and have been in the Opportunity Zone arena from the start. We're now on to our fourth fund. And then Mr. Jake Devine, the co-founder of Oz Fund Hub, as we mentioned before, great site to go look for particular funds. And then Mr. Andrew Spellman, Director of Construction and Development from Plus Capital Partners, will take us through our latest opportunity. A little bit about USG Realty Capital. We're a team of maybe 7 core individuals, totaling over 100 years of experience in real estate development and asset management. We're actually domiciled in the greater Seattle area, although I keep my home and office in Santa Barbara, California. I'm actually from Walnut Creek, California, if anybody on this call knows where that is. So I grew up in Northern California. So I still, the company's basically in Santa Barbara and in Seattle. We've raised over $2 billion in investment equity and over $5 billion in assets acquired, over 30 years of the combined experience between all the principals. And we're now on to our 4th Opportunity Zone fund and our 10th asset since 2019. And we're very happy to display that we've received some very nice accolades both Real Asset Forum and globestreet.com named our very first program the top fund in the country for economic revitalization. So we're very proud of that, and accolades from Real Asset Advisor, Forbes, and I currently sit on the Opportunity Zone Roundtable for the New York Times as well. So again, we work really hard to make sure we're doing it right. We also want to make sure that we're being represented properly in the industry, not only from the legal side, but from the political and government side as well. Our current track record, I'll go through this quickly. We do like the Pacific Northwest. Not all opportunity zones are the same. So our first project, Marina Square in Bremerton, Washington, that project is actually 99% built, and we're actually in pre-leasing now. This was the fund and the project that was named the top fund in the country that I mentioned before. We also have Market Flats. Sorry, I'm just trying to move something out of the way here. We also have Market Flats in Olympia, Washington, which is also now in pre-leasing. All the equity has been raised for that in pre-leasing. And then Market Square, which we'll hear about today. And then Peyton Lofts, which will be our next opportunity in Spokane, Washington. We do have one project in Hillsboro, Oregon, just outside of Portland, called 9th in Washington. It's in final stages of construction right now. And then we're in final stages of construction with our Bristol, Connecticut assisted care facility called Kind Care, which is really hitting a home run right now. We're already pre-leasing 1 to 2 new contracts a day. So this is also in pre-leasing. So, and then in Wisconsin, elevation 1659, which is now under construction. And this is also in our portfolio. And actually, this is one of the few that is still available for investment. So if you look at our track record, 10 assets, 4 separate funds. We're currently managing around 258, almost $260 million in assets. 2 are in pre-leasing, 2 are in final stages of construction, 1 is under construction, and then Market Square is set to start in April of 2023. So with that, and we'll get back to USG in a little bit, but I want to take this opportunity to introduce my friend and colleague and somebody I admire in the Opportunity Zone industry, Jake Devine, to talk to you about the present and the future of Oz. And he'll be covering the timeline and benefits and update on the Opportunity Zone initiative, and then also some potential great news coming out of the regulatory environment. With that, I'm going to turn it over to you, Jake. Thank you, sir.
Greg, thanks for having me on. Probably should just start by saying condolences to Ashley. Ashley's been an advocate of the Opportunity Zone program for a long time. I had the chance to meet him a few weeks ago. Anyway, best to his family. And Greg, thanks again for having me. So I'm here today to really talk about the Opportunity Zone component of this fund. I've been in Opportunity Zone fundraising for about 3 years now. Really excited by the industry. I have started, business with a few partners after seeing the progress the Opportunity Zone initiative was making a few years ago. And today we're going to go over just a few things, kind of the basics of Opportunity Zones, OZ 101, the tax benefits, some of the kind of timing implications that you need to be aware of, basic mechanics, et cetera. And then we'll take a look at where the market is, the Opportunity Zone market. And then we'll finish by looking ahead to some legislation on the horizon, some exciting regulatory updates. Let's start by just defining what is an Opportunity Zone. What is it? What am I referring to when we say Opportunity Zones? What you're looking at is a map of Opportunity Zones. And what these are low income census tracts. Back in 2015 and 2016, a group of economists and then soon thereafter congressmen got together and they said, hey, we have some low income communities around the country that have really been neglected of private investment in the post-08 collapse kind of recovery period. And they asked themselves, how can we stimulate private investment in into these areas. And so what they did is they went to the state governments and they said, here's a map of all of the census tracts. Think of census tracts as almost like zip codes. They're not quite the same, but for the purpose of this explanation, think of them as being very similar. They said, here's a map of all the census tracts in your state that qualify as low income. And then they left it to the states to essentially circle 25% of those tracts and designate them for the OZ program. So in 2017, the Opportunity Zone legislation was passed and these tracts were nominated, and the government basically decided to stimulate this investment. What they would do is they would offer tax incentives to folks who had capital gains to roll those proceeds into funds that were investing their capital into assets inside the zones on this map. Now, this map might not look like there's a lot of opportunity zones, but there's actually about 8,700 of them across the country. As Greg said, not all OZs are created equal. Variety of locations, variety of investment opportunity, but that's essentially what we're looking at here at the Opportunity Zone map. The zones are the regions, and the vehicles are the funds. The funds are the vehicles that deliver the capital into these areas. So before we get into kind of defining what the tax incentives are, let's first talk about how you become eligible for the tax incentives. And I kind of talked about this a minute ago, but to be eligible to invest the really kind of the magic of opportunity zones is kind of the broad band of investors that the tax benefits appeal to or apply to. It's really anything that the IRS deems as a taxable capital gain. For those of you who are real estate investors, you're probably familiar with a 1031 exchange. A lot of comparisons are often made between opportunity zones and 1031s. One of the differences, there are many similarities and differences. One of the differences between an opportunity zone and 1031 is a 1031 is for an investor who's coming out of a real estate investment and then rolling those proceeds back into another real estate investment. That is not the case for OZs. It's a little bit more broad than that. You can have a capital gain from the sale of really any asset. And there's usually three or four main buckets of capital gains that we see. It's the sale of stock or business. It's the sale of real estate. And then also, there's crypto and other things that have popped up over the last few years, but any asset. Now, moving on to the tax benefits themselves, there's really three core tax benefits with a little bit of an asterisk, and I'll get into that in a second. The first is a temporary deferral. So let's say you have a capital gain. What happens when you have a capital gain is you have 180 days to invest the taxable gain portion, not the principal, the taxable gain portion into an opportunity zone fund. And what happens when you do that is the taxes on that gain are deferred until the end of 2026 and then paid in April 2027. So pretty simple deferral, first tax benefit. Second benefit is a step up in basis. And so what that means is, let's say you had a using the previous example, let's say you had a $500,000 capital gain. If you receive, let's say, a 10% step up in basis upon paying those taxes in 2027, what that means is instead of paying taxes on $500,000, you're only going to pay taxes on $450,000. So it's a second benefit, step up in basis. The third benefit, and this is the big hook. This is what I think so much of the popularity and growth of the Opportunity Zone program can be attributed to is this third benefit here. And it's the exclusion of capital gains taxes on a federal level for any Opportunity Zone investment held after 10 years. The reason I say at a federal level is because on a state-by-state basis, some states have agreed to comply with the program, some have not. But irrespective of state compliance, at a federal level, if you hold an Opportunity Zone investment for 10 or more years, all profits come out federally tax-free. And that's really what draws people in. Now, if we go to the next slide, the reason I said there's an asterisk is because the step up in basis benefit technically expired at the end of 2021. Basically what the government said in the initial legislation is if you hold your investment for 7 years prior to paying your taxes, you would get a 15% step up in basis. If you hold it for 5 years, then you would get a 10% step up in basis. So you work backwards from the 2026 deadline. The 15% step up in basis ended at the end of 2019, and then the 10% step up in basis ended at the end of 2021. New Year's 2021 was a bittersweet goodbye to one of our tax benefits in the OZ program. However, there is some legislation on the horizon that could be bringing this benefit back, and I'll get more into that in a few minutes. So perhaps not a goodbye, but rather a see you later. Anyway, more on that in a few minutes. Quickly here, we'll go through just a quick example investment, what this looks like from an investor perspective. So here we're assuming that an investor has a capital gain in 2022. Let's say early 2022, you invest those proceeds into a qualified opportunity fund later this year. Because it is in 2022 under the current legislation, there would be no step up in basis. But as you can see here, the taxes on that capital gain would be deferred through the end of 2026, and then the taxes would be paid in April 2027 or October 2027 if you're filing an extension. What you see in a lot of the business plans for these opportunity funds, and I'll let Greg get into this more, later in the presentation, is there'll be a refinance event sometime in 2025 or 2026. Essentially a partial return of capital to investors, a non-taxable event, and that will allow them to pay their taxes come 2027. And then you fast forward 10 years, and that's where you get the sweet tax-free profits at the end, federally tax-free profits. But this is just a basic example. There's all sorts of different ones you can make, but I think this conveys the important points here.
Jake, do you mind if I just jump in to make one quick point? Because I think you covered something that's, I think, really important, especially for investors that may not have invested in opportunity zones before.
Sure.
If you look in the middle of that slide, it says April 15, 2027, you pay your taxes on your deferred capital gains. Jake had made the remark about refi. Almost every opportunity zone fund, I don't look at everybody's deals, but one of the biggest questions we get is, hey, I put all my money or put my gains into a program, how am I going to pay those taxes in, at the end of 26 and going into 27? And that's a key thing for all investors to do their due diligence on, is to see what's the expected amount of return of capital or capital distributions back to you before the end of 2026. And you want to make sure it's going to be enough for you to actually pay your taxes, so that your investment in opportunity zones actually works on its own steam and you're not going out cutting checks. So we could talk about that later, but that's a big point, not whether it be us or anybody else, you need to look at that section. With that, Jake, I'll go to the next slide for you, sir.
Yeah, no, point well made. Thanks for jumping in, Greg. This is just a quick kind of snapshot of the OZ market right here. And really what this just conveys is the really rapid and successful adoption of the program. This chart here on the right was put together by Novogradac. Novogradac is a professional services firm based here in San Francisco, and they're essentially recognized as the industry leaders right now in data collection for opportunity zones. They do rolling surveys to try and track how much money is going into this program. And as you can see here on the right, through Q3 of this year, they've tracked $32 billion of equity investment. However, they also say that their surveys probably only capture about 30% of the market. So you want to put probably a 3 to 4x multiple on there, which means we're at around $100 billion, which is really exciting because early in kind of the program's infancy, $100 billion was kind of put as a best case outcome for the program over the initial kind of 7 years, the 2019 to 2022. So great progress so far, definitely quicker than anticipated adoption by the investor market. And we probably only have partial market penetration right now as well. There's still a lot of people who are learning about OZs for the first time, whether they're advisors or new investors. We have seen this year, a little bit of a lag. There's a little bit of a lag between macroeconomic behavior and OZ investment velocity, but it's no secret. The economy is not in the same condition it was in a year ago. So we saw we saw very high investment velocity early in the year, but it's been a tough year in the market. We'll probably see a little bit of a slowdown in Q3. Q4 usually picks up a lot. Q1, Q2 next year will be interesting. So there will be some drag effect by macroeconomic conditions. But that also could potentially be offset by this new legislation right now on the Senate floor that we've been referencing throughout this discussion. And that's a good segue into into our last slide here.
And I do have a couple questions came up, Jake, and it's a good time to answer them. And by the way, I just noticed there was a mess up on this slide. We'll be sure to correct that before we send these out. But we were asked by wealth advisor of ours from Illinois. He asked, and I think this is good for the audience to know, is he asked, does an investor have to put in all of their capital gains into an OZ fund? Could you just touch on that quickly?
No, they don't. Any portion of their gain is eligible. There's no requirement that it needs to be the entire gain. Actually, I'll share another question that I've heard from a lot of investors kind of along those same lines, which is if they really like a project, can they invest, not just their gain, but some of their basis? The answer to that is they can, but the basis won't be eligible for the tax treatment. So that's kind of another relevant kind of data point to what you're asking. But the answer to your question is no, it does not have to be the entire gain. And very frequently we see investors break them up.
And that's a great point. I would say we kind of looked at this ourselves, and we're about 10% of what we bring in our funds are not capital gains. It's just people making straight investments into the deals themselves. Let's go to your last slide here, sir.
Yep.
Thank you for answering that question.
Yeah, no, questions are great. Feel free to put them in the chat or reach out after if you have any more. I'm always happy to connect with folks. So last kind of piece of this OZ presentation here is a quick overview of an updated proposed update to the Opportunity Zone legislation. What happened here is earlier this year, a cohort of the same bipartisan congressmen and senators who passed the initial bill got together and said, hey, this program is outperforming expectations. We're seeing a lot of money move in here. And as a result of that, we should, one, update and improve reporting requirements, and then also consider extending or improving some of the benefits. And some of the meaningful provisions of this bill are kind of outlined on this slide. The first one here at the top, extend the deferral period from 2026 to 2028. So that basically just means, well, it's relatively self-explanatory, that the deferral period would be moved from the end of 2026 to 2028. What that would also mean is the investment window, which right now would close at the end of 2026, would also be pushed back to 2028. So it would extend essentially the lifetime of the program. And the second one here, the step up in basis, is what I was referring to earlier. If this legislation were to pass, the step up in basis benefit would be brought back, and it would also apply, by the way, retroactively. So anyone who invests before the end of this year would receive a 15% step up in basis. And anyone who invests before the end of next year would receive a 10% step up in basis. And then at the end of next year, that benefit would re-expire. Certainly, though, I think we would all be excited for a basis step up resurrection. Third benefit here, early sunset for certain census tracts, that is worded to sound almost like some sort of penalty. It's not really. What that means is they're just going to redraw the map for opportunity zones. In 2017, they had to use 2010 census data, and census data is collected every 10 years. So now we're in 2022. The program's performing super well, and we now have 2020 census data, which is more current and therefore more accurate. And that's a big part of the reason why I think this legislation has a likelihood to pass, is that's just logical. If you have something that's performing well here, and like this program, you should base it off of accurate data. And then update some reporting requirements. There's an absence of thorough reporting guidelines right now for a lot of these funds, and the congressmen are essentially advocating for more transparency there, which I think both advocates and detractors of the program would support. Fifth benefit, allowance of fund of funds. I think this is actually a very powerful and potentially overlooked provision of this bill. I think a fund of funds, it would essentially open up an entirely new and very powerful capital pipeline for OZs that does not exist, and then a creation of a federal fund for state and local use. But that's a summary of the OZ legislation. If it were to pass, essentially the tax benefits would reflect kind of the pre-2022 tax benefits that we saw a little while ago. But really, just to kind of summarize this discussion, I would say two things. One, I think what we're seeing in terms of growth in the opportunity zone market, especially given how young it is and given some of the headwinds, it's really exciting. It's really exciting. That's why we're investing in it, our business, and Greg as well. So excited by the action in opportunity zones. And the second and final point that I'll make, then I'll hand it back to you, Greg, is like Greg said, not all opportunity zones are created equal, and not all opportunity funds are created equal. There's a saying I really like, which is, the opportunity zone program does not make a bad investment good. If there are no, you can't have tax-free profits if there are no profits. I'll put it that way. However, the opportunity zone program can make a good investment really good. And through our business, we've had the chance to work with a lot of different sponsors. The relationship with USG has been excellent. We're really a fan of their team, what they're doing, their vendors, and it's a pleasure to be here. So with that, please feel free to reach out with any questions. Thanks, Greg, for having me on, and always here to help you guys.
Thank you so much. That was a wonderful presentation. And Jake, if you don't mind, we'd love for you to stick around. We're getting some Q&A, and we'll ask at the end. And if there are any questions that we don't answer on this call, we'll be sure to email you back and let you know. I do want to make one note of this opportunity zone legislation. This actually was put into Congress in April of this past year. And so we were all very excited about it. There's very little opposition to it. It's truly bipartisan. It's one of these situations where most people believe there's no reason for it not to be extended. And so those are great benefits, but we can't say that it's actually going to happen. The indications are all that there's very little opposition or any opposition at all. It's bipartisan, not by one on the left and by one on the right. It's more like 30 on the left and 30 on the right. So the only things that they're being asked of right now is a little bit more reporting, which we're all for, and being able to kind of bring back in the step up in cost basis, because a lot of people really missed out on that. But again, I want to make the point of, even if that's not there, and Jake made this point too, the real superpower of opportunity zone investing isn't the 15% and the 10% step up in basis. It's really being able to defer your taxes, not paying any taxes on that money for an extended period of time, and letting that money work for you, plus a full 10 years of tax-free growth. To me and to most, that's the real power of the opportunity zone. But of course, we would love to see this go through. It may pass in lame duck between now and the end of the year. And then all indications are, if not, it'll be sometime next year. So I just want to make sure that you understood that. And basically what it would do is it would put the original benefits back on the table, like Jake had mentioned earlier. Again, Jake, thank you so much, sir.
Thanks.
We're gonna move right into investing into opportunity zones and today's economy. I'll be covering this section. Is it the right time to invest? I'll talk a little bit about USG, the difference and how we do things. And then we'll talk about the Market Square apartment opportunity. And I'm going to go into the investment structure because that's very important and how it's engineered, the pro forma, and then the proper investor asset management and oversight. So where we are right now, and by the way, I always urge people to go to the right-hand corner, click on our website, ask for a meeting or a call. These webinars are never long enough to dive into all the different categories that we'd really like to cover. But the bottom line is we have a stock market that has been on a run for the longest period of time in history. It got shaky, it came down, it got shaky, the volatility has started to pick back up, and it's been on somewhat of a downward trend and then a little bit up. So it kind of goes up and down and all around, but it's also a great opportunity to actually harvest those capital gains. And what we're seeing is most of the money coming into our funds are from stock trades, or they're coming from real estate assets that they're selling and not being able to really find a good 1031 exchange. And this becomes a way to actually do a tax advantage investment. And then a lot of businesses, I would say almost not half, but 30 or 40% of the money that we're seeing come in is really from businesses selling and taking those gains. But again, we're in a situation in our economy right now, high interest rates, they keep going up. High inflation, it's really a great time and opportunity to rebalance a portfolio to stave off the risk of increased inflation. And whether you want to believe we're in a recession or not, my philosophy is we have to build our products as if we're in one. And that is hard assets and right structure. So maximize your capital, maximize your tax advantages. And the opportunity zone is really one of the very best ways to do that. How we do things at USG, and this is just how we model things, we like to put ourselves in the wealth advisor's position. So there's probably a lot of investors on the call, and there's a lot of investors on the call that have the financial planners or wealth advisors. We want to put ourselves in their position in the sense of how we risk, like a wealth advisor, number one, is always going to look at it from risk. How do I take my investor's dollar and protect that dollar? So our modeling is always going to be built on a risk mitigation model and being as conservative as possible. And again, I can't get into all the dynamics now, and we hope we have the opportunity to do that. And then the next is oversight and accountability. How are we not only looking out for your investment, but we like others to be looking at us too. And that means we have third-party oversight. We do social impact studies. Everything we do is accountable. So it's not just us overseeing your investment. We like to have third parties looking at us too, to make sure that you feel comfortable with your investment and that we're doing things right. And again, doing things on a conservative basis so that your return of your capital is of tantamount importance. And then an alignment with the investors where we actually don't get paid until you've got all of your money back, plus your preferred returns. And then we have very high preferred returns, and that's a contracted amount. And it could be anywhere from 10 to 12% in our programs. And that just means that we don't get to share in the profits until you get to that mark. So that's really putting it out on our side of the fence for our investors with these high preferred returns. And then lastly, we really want to honor the spirit and intent of the initiative. The Opportunity Zone Initiative is there to revitalize communities, to give an injection of equity and investment into communities so that they get that growth that they're either growing already and need a little extra help, or they need help in growing. And we want to look for those investment quality areas that can hold that value and increase that value actually over a 10-year period of time. But we want to do right by the local community, the local economic development alliances, and we want to do projects that are inclusive, not exclusive, meaning we don't want to go in, build, and kick a lot of people out. We want to go in, build, and actually facilitate and honor the community. So that's why we developed Investors Choice. It's our fourth fund. When we came out of COVID, we wanted to develop a fund that allowed us to go into smaller projects, projects that only needed 4, 5, 6, maybe $10 million of equity at any one time, maybe 15 million on the higher side. But it's hard to bring a fund out for only $5 million. So we wanted to come out with an overall umbrella fund. It allowed people to have multiple projects around the country in these urban areas that are infill, that have lower risk, in recession resilient asset classes. But we wanted to give our investors a choice where you don't have to go in to all the projects. You can go into 1, 2, 3, 5, whatever you decide, and for any amount that you want. And what's nice about that is you could be in multiple projects with just one reporting document and a K1. And it just makes it real easy for you to control your investment. And so when you look at our fund structure compared to the other types of funds, blind pools, a multi-project where you have to invest in all of the projects, or single project, we really look at it from giving the investor multi-project diversification, but giving single project concentration as well. And then our structure is to co-partner with our developer partners so that you know that we're actually overseeing the developer on your behalf, a tax opinion on all the programs, third-party regulatory and compliance on us and everything we do. And then each one of our projects has a social impact study that's done by a well-regarded group called DRC Impact Reporting out of Washington, D.C. And then lastly, you get to direct your own investment. So we think we've come up with a really unique and what's the word I'm looking for? We'll just say unique, a unique structure that really allows the investor to have control over where the money is and how much, but also has proper oversight on behalf of each investor. So right now our pipeline is, we're all over the country, a number of investments in Washington, one in Oregon. We have a current offering in Milwaukee, our assisted care facility in Bristol, Connecticut, and we're currently doing final due diligence on projects in Las Vegas, Nevada, and in Houston, Texas. And of course, we'll talk about our Tacoma deal today. So this is what our portfolio looks like right now. We still have a little bit of money left in our Elevation 1659 project. Construction has already started on that project with a 12% preferred return. And then far to the right is Peyton Lofts in Spokane, Washington, a 10% preferred return, which we're set to launch that one really soon. And then the deal that we're here to talk about today, Market Square in Tacoma, Washington, 176 units with a preferred return of 10%. So our fund structure looks like this: $50,000 minimum investment, very small. We want to make sure that most everybody that has money and gains can invest, with preferred returns of 10 to 12%. And then our distribution is 100% goes to all of our investors in profits until you've got all your money back, plus that high preferred return. And then after that, it's a share with us, 80% to you, 20% to us. And there's no what's called catch up. We don't reach back in and catch up with the investors at all. So a portfolio can actually look like this. You have $1 million investor who went across 3 projects. You have a $400,000 investor went into all the projects. You have a $100,000 investor went into 2, and you have this investor with over 2 million invested across 3 projects. So you heard me talk a little bit about smaller projects. One of the focuses that we like to dive into is called infill projects. For those who don't know what an infill project is, and we stick strictly to this, it's really an infill development, and it refers to urban areas that have been developed or in existing development patterns and need to be revitalized. And as I always like to tell people, how you get out of an investment is as important as how you get into it. Why is that important? Well, I'll go through these pictures and I'll explain why. In our first project, it was called Marina Square in Bremerton, Washington. You can see that it's in between buildings. It has barriers to entry with Puget Sound. And what you have to be concerned about in any development project is if you have to hold for 10, 11, all these the opportunity zone funds, it could go past 10 years. It depends on if it's the right time to sell. So you have to remember, in 10 years, your project is going to be one of the older projects in the neighborhood. So for it to compete and get maximum value, it's better to be in what's called an infill area, because those will hold their value better, meaning you don't have to put a lot of money into those projects at the end to get it to its maximum value to sell if there's a lot of competition around you. So you want to be in areas that are infill, high barriers to entry that other people can build in the area, and it equates to better value at the end, and therefore not having to invest a lot of money at the back end, which helps you exit the project. Then you have Milwaukee. Again, this is our project E1659 in Milwaukee. Barriers to entry, you can see the Milwaukee River right there, and you have track 113, the highest growth track in the city of Milwaukee. Again, a dense area. Market Square here in Tacoma, where we're building, you can see a dense area. It's infill. It's right next to the University of Washington. It has all the metrics there that this will be a big success and hold its value and keep maximum value in 10 years. So with that, I want to just jump in a little bit. That's our philosophy. That's how we like to do things. Let's talk about Market Square if we can. It's our latest offering. It's in Tacoma, Washington, 176 market units, multifamily. There's also an element of student housing because it's right next to University of Washington, Tacoma. And we're co-partnering with our developer plus capital partners. Andrew Spellman is here today to talk about the building of this project. It's right in the heart of Tacoma, the fastest growth income tract in Pierce County. This is a $22.5 million equity raise for our fund. And we have already facilitated the construction loan. We can talk about that later at $25 million and a project cost of $47.5 million and a preferred annualized return of 10%. And our partner here again is Plus. General contractor will be Pavilion Construction. But if you've been in the industry as long as I have, and you've gone through 3 major recessions, frankly, I'm all about demographics. When we went through the last major recession in 2007, 8, 9, 10, 11, it didn't matter if you had a recession resilient asset class back then, everything went down in value. So true recession resiliency to me has to do with the demographics. Where is it located? How is it going to perform during good times and in bad times? So let's take a look at that. We do have a market study that was done by Summerfield Property Management. We just received it in October of 2022. So it's all very good information. And looking through that, you look at the areas around Seattle that are the highest growth, key growth components in that particular area. And you have, of course, Seattle. Seattle's becoming a lot like San Francisco, a little bit overcrowded. Values are a little bit too high. You're not getting as much for the dollar, but it is the highest dollar for rent. And then you're finding that Kitsap County, where our Marina Square project is also growing. It's less expensive, but now you have a 1-hour ferry going across. So basically you have transportation going across to Bremerton, but where most of the growth is actually going is in the Tacoma area. And that's because to the east, you have the mountains, to the west, you have Puget Sound in Seattle. And so the growth push is actually going south past Tacoma towards Olympia. And that's why Tacoma tends to be the highest growth area of the 3 major counties of King, Kitsap, and Pierce County. So from a demographic standpoint, we really love the Tacoma area. In this area, you've got Washington, University of Washington, Tacoma, and the demographics are great. Currently 4,500 students, and their growth plan is to get to they're committed to get to 10,000 students. There's no timeline on that, but they believe it should be done in the next 5 to 6 years. $43 million investment into the school. And they expect, or they have a goal of 12% of their student body. So 12% of that 10,000 needs to be on campus, and there's just not enough room to facilitate that. So that's going to be an ancillary additional driver for demand for our project. Looking at the employment, these are all names I know everybody knows that are either headquartered in the area or have a very big presence in the area. Amazon, Expedia, Alaska Airlines, Raytheon, Washington University in Tacoma, General Dynamics, Costco, Boeing, Microsoft, and Starbucks, and then a very big presence with the military, with the U.S. Navy and the Army. And so that's why Pierce County continues to be the fastest growing county. From a transportation standpoint, we love the fact that it's becoming a walkable area in Tacoma, very popular with cyclists. The bus and streetcars named Sounder are growing, and you can actually get to downtown Tacoma by foot within 10 minutes from this facility, 5 minutes by bike, or 6 minutes by streetcar, and you can get to key areas like grocery stores, the medical facility, and the Tacoma Dome, where a lot of sports are played, all within 20 minutes or so. And then access to Seattle is becoming closer and closer with the Sounder commuter rail, which is already online and only growing. But something a lot of investors really want to look at is, what do the market rents look like? Can it hold its market rent and get us the returns we're looking for? If you look at the 5-year growth of this area, just in the unit types, which we're focused on: studio, 1 bedroom, 1 bath, 2 bedroom, 1 bath, you're looking at a 5-year growth of anywhere from 21.9% all the way up to 32.4%. And the average over the last 5 years of 28.4%, well above the national average, well above any pro forma increase in rent. And this is expected to continue over the next 5 to 10 years, at least the next 10 years of this project. Like we said, Tacoma is only getting denser and denser. And then lastly, look at the rent growth by city. You look at Tacoma, the surrounding areas, Tacoma, Olympia, Everett, Bellevue, and in Seattle, you'll see that the 5-year growth in Tacoma is 36.9%. And it's the highest for any of the major cities around the greater Seattle area. So we're very confident in this investment, and we're confident over the long haul that we'll do well above what we pro forma in as from a return standpoint. So in the end, why do we like this project? For these reasons. It's an infill project. It's infill development. There's limited capacity with barriers to entry. Again, how you get out of the investment is just as important. Strong long-term demand for multifamily housing. There's strong employment characteristics with a growing workforce in multiple corporate headquarters in this area. University of Washington plans to grow from 4,000 students to 10,000 students. And that's only going to increase demand. And this is big. The local government and the Economic Development Alliance are very supportive of this project, which can only help any development project when it comes to permitting, design and review, et cetera. And then the rent growth continues to be well above the national average. So those are just some of the reasons why we like this property so much. With that, I'm going to now pitch the ball off to Andrew Spellman to get into the dirt, so to speak, on the construction itself. I did see some Q&A questions come up. So while Andrew is talking, I will go ahead and answer those questions. Andrew, go ahead, sir.
Yeah, thanks, Greg. Appreciate the time. I will move fast. I know I want to leave some time for Q&A. So we'll just jump right into who Plus is, and then we'll dive into the project. So Plus is a greater Seattle area focused real estate investment and development company with our primary focus on ground up, mid-rise and high-rise multifamily mixed use projects. You can see just a sampling of some of our work here with recent completion of the upper left project in South Lake Union. So let's dive into the project and focus on that. So here's Market Square. What we really liked about it is the efficiency, the amenities. It's highly amenitized. We've got internal courtyards in multiple locations, laundry rooms on most of the floors, 2 kitchen and lounge rooms. The top floor clubhouse, which is adjacent to the open air deck that you can see with Mount Rainier, should be in that rendering. We've got a fitness center, rooftop secured pet relief area, which I think is a big market differentiator. It's a safe, secure location for 24/7 access for pets, which is nice to have. Marketing really likes that aspect. plenty of bike amenities. And then on the, the unit finishes, they're fantastic finishes, flat panel cabinetry, quartz countertops, high speed internet, of course, and then the washers and dryers in probably half the units, which we consider the premium units. And then let's jump into the next slide on our contractor. So location, Greg did a good job on that. I think that, that was the first thing that attracted us to it. So these pictures on the bottom, those are all these things, cultural sites, convention center, UW, these are all within 2 to 3 blocks. Chihuly Glass Museum, multiple museums, and the 100 feet away is the large UW fitness center for down there. So although we've got a fitness center on site, any students able to walk down the street and use that. So I think that for us was a really nice amenity, and the amount of food, coffee shops, and shopping just 2 streets down is a really nice add for this. The proper downtown is probably a 5 to 10 minute walk. So for us, location was key. Pavilion, top 2 items really stand out for us. 124 projects completed, 8,600 units completed with 15 years of continuous operation. Those are nice metrics for us to see. They're primarily West Coast builder up and down the West Coast into Arizona. So they've got a lot of experience in this type of products. So they've been a great product or a partner so far. And then we just got our GMP recently. On the next slide, we'll see that we came in at a number, and we immediately started working to drive that number down. Right now we're at 313, and we continue to, with our goal to get sub 300s. And, just because we sign a GMP doesn't mean we stop VE. We continue to do it. And what we strive for is we don't value engineer program. We don't delete program. We just want to make it more efficient. How do we secure our contracts and our price moving forward? We end up, signing contracts for some of the early work subcontractors, leaving us flexibility with letters of intent for the other subs to get better pricing as materials continue to drop in price, which we're starting to see. Schedule came in at 22 months, and we've been able to whittle that down to about 20 months. And so how do we vet these contractors? We call developers they've worked with, we call consultants that have worked with them, subcontractors, try to build a picture of who they are and make sure the people that they're providing for a project are going to work for us. We bring in subcontractors, key subcontractors, have interviews, tour projects with them. We meet with the city, make sure everything's in order. We've got our MFTE fully validated, so that's another checklist. And then we use our third-party inspections and design consultants for regular construction updates, while also having a veteran construction manager, boots on the ground with 40 years of multifamily experience, sort of round out that piece. It's really our financial strategy for the project are all sort of those things that we've touched on today. The strong rent performance. We really like where it's trending. The efficiency is really nice in this project. It's got very little parking, which was something we wanted to make sure we were comfortable with, and we were able to really get comfortable with that, knowing that we are surrounded by parking lots. We've got well over 300 available parking spots with leases in hand, ready to sign if we need to start adding parking in the future. Our lower average cost, just based on the efficiency and location. We get a benefit by not being in downtown Seattle proper, while being in Tacoma. We save that money. The MFTE aspect of it is a really nice win. And then the low loan to value ratio is just the, sort of rounds it all out.
Hey, Andrew, thank you. And I know you were kind of pushing there. So I know that's a lot to handle all at once. But again, I urge people that if you have interest in us, in learning more, just the academics of any way we can help in any way, shape, or form, we're here to help you. And then if you want to hear more about the project or other projects in the fund, I would urge you to go to our QRF on the right-hand side there, go to our website, and we'll be happy to talk to you. There's the QRF again. And again, we will have the PDF available for everybody to see. Thank you for being here and coming. Go to our YouTube page, and please, talk with us, see the information there, and please give us a call, talk with us at any time.